What's up, everyone? I might sound a little bit different because I'm using my wife's desk and I don't have my mic up here, but hopefully you can hear okay. I wanted to go over my trade review for the day and then hopefully give you some words of wisdom, a little bit of help along your journey. Um, so we'll start with my trade review. Really not a great day, but not bad. Um, we'll start with buying close of bar 15. So to me, we're in a strong bull trend, and that's leg three. But for me, it's reasonable to take a scalp right here with the option to scale in. I scalp out around the Globex high, around the high of bar 16, and then my next trade is buying below bar 16. I'm looking for a pullback, expecting a trending trading range up, possibly a bull trend day, but I'm aware that we could get a big opening reversal down. We could get a trending trading range day, and we could fall below the open of the day, the low of the day in one bar, actually. That is possible as well. Low probability bet, but it could happen. So we get a big pullback with bar 17. I take my first entry around the low of bar 15. And then the breakout bar gets a lot bigger. And I think, wow, well, that is certainly not what I expected at all. That's a much deeper pullback than I expected. Now, with that deep pullback, there's several things going through my mind. And first of all, we have buyers below 16, probably. We have buy the close bulls on 16. We have buy the close bulls on 15, and we probably have bulls like me buying around the low of bar 15, below the swing point of 14, around the low close of bar 11. We've got a lot of buyers that are getting trapped right now, is what the point I'm trying to make. And this one bar changes everything. This is a major reversal, and the market's going to have to adjust to this reversal. But what are the odds that we just get a measured move down immediately in the next bar or two of the close of bar 17? And to me, that's unlikely. I think it's a lot more likely that we'll get a pullback and we'll test the breakout points above before we get a big move down. So I buy the close, I add on to my position at the close of bar 17. You might be thinking, well, that's kind of a crazy thing to do. Shouldn't you just get out of the trade, take the loss? And I'm going to go over, more of the higher time frame context and why I decided to stay in the trade. Yes, I could reverse to short, but the problem is we're at the bottom of a trading range as of the close of bar 17, and I don't want to get short at the bottom of a trading range. To me, it's a lot more likely that bar 17 will get a second leg down, but it'll likely lead to a trading range rather than a strong bear trend that completely undoes all of the rally that we've had since the open of the day so far. But it certainly changes the premise, and now I'm just looking to get out of the trade, and maybe make a few bucks if I can, but I'm more concerned about, how much lower are we going to go and how quickly are we going to do it. But during that bar, I think about all of the trapped bears who were selling during the rally. And to me, we have support around the bar 11 close, the 12 low, and the close and high of bar 5, because there are going to be sellers at all of those prices who were selling during the rally and are trapped into a losing position as of the close of bar 16. So now the market is giving them a very brief but great opportunity to get out of their losing positions, because the bulls may end up buying bar 17 or buying somewhere below it, looking for a second leg up from the rally on bar 5. But trading like that is basically trading the higher time frames. And I realized when I was in this trade that I've actually made a mistake. And what I'm doing is I'm focusing a little bit too much on the higher time frames. And I think that is something I did last week as well, that I've got to think more about and work on. Because I really could have just waited for the close of bar 17. Once you get a pullback that's undoing those two bull trend bars, if that's happening in one bar, it could go a lot further. And if it does go a lot further, that pretty much changes the whole trade thesis of buying below, 16 to begin with. I wanted to buy a distance below 16, but anyway, I forget what I was saying, but But yeah, likely buyers and a bounce around the 12 low. So I buy the close of bar 17. I'm using a very wide stop. Where's my stop? It's down here. It's a very wide stop. I mean, the range is relatively small today so far, so it's not that big of a deal. And if you say, "Wow, I mean, that is a really wide stop," well, yeah, it is a really wide stop. If I'm going to be scaling into a trade, and if it goes bad, what distance stop do I have to use so that if I do take a loss, my loss will be smaller than the win of the trade if it ends up working out. And I've done research to understand what that is and how to do it. Of course, there's going to be days where I'm wrong and that stop gets hit, and I take a much bigger stop. I take a much bigger loss than what is ideal. But you have to do the research to understand the appropriate time, how to structure your trade so that you have a high probability of at least breaking even and, a high probability of not losing money. That's most important. Least important is making money. But anyways, so premise is invalid, but likely a trading range. So now we just need to get out of the trade. I buy the close here. We get a follow through bar after some hesitation. We try to test the breakout gap with 14 low. Don't quite get there. Retest the high of yesterday and get another strong bar down. And at that point, I'm thinking, man, this could really just run right to the low of the day and hit my stop. And but I'm watching the higher time frames. I'm watching the smaller time frames. I'm watching this time frame, and I'm a little bit crazy. So I at the close of bar 18, I decide to scale in one more time below bar 18, and that's my final scale in. If the market keeps going against me at this point, I'll just have to eat a big loss. And with my research and understanding of trading systems and the understanding of scalping, that is the nature of scalping. You're going to have smaller wins, and occasionally you're going to have bigger losses than your wins. That is the nature and trader's equation of scalping. And the only reason that scalping works is because you have high probability. And that is why I'm scaling into this trade, because that is, with every scale in, that is increasing the probability that I will not lose money and that I'll even be able to make some money. It's a different, it's a completely different mindset to be a swing trader. You have a lower probability but much higher reward. So the losses are smaller and your reward is much bigger. Scalping is the opposite. You have high probability, you win most of the time, but when you do lose, you knock out a few of your winning trades. So anyway, we get a bull bar with 19. It's pretty good size, pretty deep pullback. Likely the bears get a second leg down, but this is climactic behavior. We have a strong trend up. We're around the midpoint of the Globex range. Probably there's support in here for a bounce. We get a bull bar, some follow through, but it reverses. That's not a very good looking low one short. Probably buyers are below it, and they were. Once we get this bull bar, I'm feeling pretty all right. And I get out of the trade above bar 18. There are likely more sellers above 18 and scaling it higher. So I'm not willing to hold long when the market is clearly short. But we get a two-legged rally at the close of bar 22. I see some weakness with bar 23. This looks like a two-legged rally in a brief bear trend. So I sell the close of bar 23 for a scalp. I scalp out near the low close where the bears were trapped on bar 20, selling below. And then with the breakout on 24, we have this deep pullback, yes, but look at the breakout. The breakout is pretty strong. And to me, this is a breakout pullback short. This tail of 24 may be all the pullback that you get. But even if we go above this bar, the bears have done so much damage to the bulls here, it's very likely there are sellers at and above 24. We're still always in short, so I sell the close of 24, and I take profit near the low of 24, expecting a bounce and trading range. Then when we reverse up, we have a double bottom with 19, a strong buy signal bar. We do not get follow through, but we get a bear bar that looks like a pullback to me. So I enter at the breakout point of 26 high, and I scalp out around the high close of bar 22. around the high of yesterday, expecting sellers up here. And then when we start to roll over again, the bulls tried to resume the trend here. We tested this breakout point to the tick, tried to rally, but instead found more sellers. And this bar became a strong breakout bar. So I sold the close there for another small scalp, got out near the low close right here. And that's all that I did. Not great trading. This is not good. I do not like to do this. It's reasonable. It worked, but it is not good. And, it's actually, I made a mistake. The market, for me, flipped to short right around here. So this entry is actually, not smart for that reason. I should have waited for the close of the bar. And then once I saw how big the bar was, I probably wouldn't have done anything. If I waited for the close of the bar, I probably wouldn't have bought. I probably wouldn't have sold. I would have waited for this bar and then would have probably thought about selling. Right? That's what I should have done. So, I'm winning. I'm having successful days, but I'm still making mistakes. And because I have a systematic approach, because I've done my homework, things are working out all right. But I certainly have room for improvement. So anyway, somebody asked a question about breakout and follow through, and my question to you would be, what is the difference between a micro channel and a breakout with follow through? Because at the end of the day, they're basically the same thing. The difference to me is the micro channel is typically 3 bars or more. A breakout with follow through is at least 2 bars. But that's about it. That's about all the difference. Breakout of what? There's a breakout right here of this high. There's a breakout of that high. I don't know what that little red mark is there. That's probably a mistake. There's a breakout right here. The number of bars is kind of irrelevant to me. The context is far more important. Always got to remember that context is far more important than the signal bars. These are just signal bars. And then, here's a good question for you. What part of a trading system is the micro channel or the breakout and follow through? What part? What part is it here? It's the signal. And all trading systems are a function of this process. You have context first, then you have a setup. You have expectations behind the context and setup. You have a trader's equation associated with the setup based on the context and expectations. That's your risk, reward, and probability. Then you have the signal that's telling you, something is occurring, based on your understanding. Then you have the entry, management, and exit. Having systems with limitations. Somebody else asked about, what's it like to have systems that limit your behavior? And, isn't that kind of like having an automated trading system? And, not really. To me, having a trading system, it gives you limitations, sort of like driving. Like imagine driving without any traffic lights or painted lines on the road, right? It would be crazy. You wouldn't feel safe. You probably wouldn't want to drive very often at all. You'd probably want to move somewhere else. So the reason we need trading systems is to limit our actions so that we act in our own best interest. When you're driving, you need to follow the speed limit. I mean, most of the time, I speed a little bit, but not that much. You need to stop and respect all of the traffic signs, all of the stop signs. You have to use your turn signal, right? I mean, just like in, with trading, you have to consider the context and setup. You can't skip that. You have to think about your trader's equation. Think about the entry. What happens if it goes against you? Should you scale in? Or should you not scale in? When should you exit to prevent a big loss? And how do you adapt to things when they change? Like when you're driving, you have to merge on the highway. You have to change lanes. You have to pull over for police and ambulance. You have to adapt your behavior when things change. And then just a quick note, if you don't follow rules in your everyday life, you're probably not going to follow your trading rules. And having some discipline naturally leads to freedom. So rule-based discretionary trading, what is it really? To me, there's several types of systematic trading. There's mechanical trading, which is basically automated trading. You program an algorithm to do something, it just does it, and you take the wins, take the losses. It's lower probability, but higher potential for reward if you're swing. It's a swing trading system basically. Is automated systems, most automated systems. Systematic approach is completely rule based. It's more rigid. There's specific entry management, exit based on statistical research. You have to study, you have to do research. You probably won't be able to automate it because, you'll have some exception cases. It's very difficult to program context. And then there's rule-based discretionary trading, which is what I do. I have a systematic approach, but I use very specific discretion based on my experience and knowledge that allows me to have higher performance, good performance, profitable performance. It takes a long time to use that discretion wisely, and you certainly are always going to start out with a systematic approach, and over time you can introduce more discretion. Like over here, buying here, buying more, buying even more there. What the hell am I doing? And what the hell I'm doing is I'm implementing the discretion that is baked into my trading systems. With my system, the discretion is my entry. Okay, everything else is pretty much systematic, and so it's up to me to decide what is the optimal entry point to take advantage of my trading system. That's my discretion. And part of discretionary trading, rule-based discretionary trade, part of it is having some flexibility with your approach, but sticking to the rules. I made a mistake on this trade, technically, but technically I didn't. We'll go over that soon. But that's my discretionary. I get to decide what entry is appropriate for the situation, for the setup. And here's kind of my thinking with all of it. These are the higher time frames: the 15-minute, 30-minute Globex chart, and the hourly chart day session. At this time of this entry, it's this bar, and to me, this is a spike and climax. Yes, it might be a wedge bear flag. Doubt it. It's probably some sort of bull channel from this big spike up. And it's very likely that this bar is part of a pullback. And at a minimum, the high close of bar 12 should be retested. That's this bar here, because this is the close of the first hour, and this is the second hour. So this looks like a pullback to me. So that's reasonable. That's part of the analysis. I'm not just trading based on the hourly chart. Here's the 30-minute chart. We got a trend up in the Globex session. Got a parabolic wedge down, micro double bottom, maybe. And we had a strong rally. We have the double top, and we're getting a strong sell signal bar. It's very likely that the bears will sell this bar, scale in higher. But it's also very likely that the bulls will buy this close, or they'll buy it immediately below it, expecting at least an attempt at a pullback to retest this high close. Again, the high close was bar 12 over here. And then the 15-minute chart, we have a big two-legged rally up after a wedge bull flag, one pullback, two. That move is done. This is the start of something new, and something has changed. But there's a breakout point right here, a bad sell signal bar low, and the high of this buy signal bar. Both of these prices are a target. So the bears have reached this target. We're also right at the moving average. But now there's a target right here. This sell signal bar low. So that was initially what I was aiming for. I was thinking about getting out right there, which would be, I think it would be this low or that low on the 5-minute chart, but I ended up getting out right here because of the context of the 5-minute chart. Most important is the context of the 5-minute chart, but what unfolds on the 5-minute chart is going to be the result of the higher time frame context. So that is kind of the logic of the trade, why I decided to maintain the trade, why I decided that scaling in was still appropriate, why it was still valid given the context of the higher time frame charts. Now, on the 5-minute chart alone, if I were not looking at these charts, then yes, this would have been very dumb and a mistake. And technically it is a mistake for me, and I've got some work to do with that. But and I'm not particularly proud of this trade, but the logic and reason is there. Anyways, another question somebody asked about finding high probability setups. And I want to just ask you, looking at this chart, or any chart, pull up any chart, how many bars, any bar, how many bars get a second leg, a tradable second leg overall? How many? There's no setup required. There's no signal required. Just look at the bar. If it's a bull bar, did it get a tradable second leg? And if there's a bear bar, did it get a tradable second leg? Tradable means using a wide stop and scaling it, a best case scenario. And, think about trends. Most reversal attempts fail, and in trading ranges, most breakouts fail. These symbols right here represent failed trades. So if you bought the close of 51 and scaled in lower, you took a big loss. And if you bought the close of 35, scaled in, maybe you could break even here, but likely you took a big loss. There's actually another one here that possibly failed, but look at this. Pullback and a second leg up right here. And then here, this also got a second leg, but we can say it failed. Broke below, retested up near the highs, and then, broke out below. But the answer here is 96% of bars on the chart got a second leg. And that's just something to think about, that should, to me, that should kind of recalibrate your expectations of what a signal bar is, or what signal bars are, breakout and follow through, micro channel, all those things. Finding consistency. It takes a long time. You got to study a lot of charts. I've studied over 3,000 unique 5-minute charts, and 1,000 of those charts have been very high quality study. And I plan to study a whole lot more. I've made a lot of mistakes too, and figured out, who I am, what I like, what I don't like, and trade simulated to make your mistakes. Don't make mistakes with real money. Don't trade with real money until you know that you're ready. And I think most important is to figure out a system for reading the chart consistently. Forget about trading it. Just worry about reading it consistently, because if you can't read the chart consistently, you're not going to be able to trade it consistently. It just doesn't make sense. And you can't do research without being able to say, objectively what's going on the chart. On this chart that we're looking at, 93% of all of these bars got a second leg. Only the ones with these little symbols failed to get a second leg, and ended up resulting in a loss. Here's the bar is the signal. Every bar is a signal bar. The skill of trading is acting on the good signals and ignoring the bad signals. Practical steps to finding consistency. What I would suggest is to remember the problem-solving loop, the Ray Dalio problem-solving loop. Have a goal, figure out what the problem is, diagnose it, design a solution, and then execute the solution, and repeat that process until you get what you want. A practical guide to becoming a professional trader. In my opinion, I think first step is you absolutely must learn price action in full and complete. Do that with studying the Brooks trading course. Quiz yourself on the course. Design your own quizzes. Make flashcards. That's what I did. That's how I learned everything. That's how I integrated the knowledge. You can't just watch the videos and expect yourself to retain all that information. You need to watch the videos, and as you watch them, create flashcards or quizzes for yourself. When Al's talking about what a wedge is, write yourself a question. Why is a wedge important? What does a wedge mean? How do you trade a wedge? What should you look for in a wedge? Things like that. Do that for everything. Do that for every pattern, every piece of context that he talks about. And then start diligently practicing implementing that knowledge by collecting thousands of charts and naming everything on the chart. It sounds daunting, but just start. Just start small. Do a little bit at a time, a little bit every day, a little bit every week, every month. Before you know it, you're going to have a big collection. And that will help you build an understanding of day structure and buying pressure and selling pressure and patterns and traps. It is so, in my mind, it's completely required. And then you can start doing some research. Pick a signal. It doesn't matter if it's a micro channel or a breakout with follow through or even one breakout bar. It doesn't matter. Just pick something and then start, open up Excel and put in a few columns for the signal direction, the market phase, the market cycle, market state, the leg count. Did it get a second leg or not? just start simple. Do that. Run into problems and go back to that problem solving loop. And then once you finish that initial research and you have a baseline of like what to expect, you can deepen that research and put together a workable system. You can look at the pullback. You could look at what entry is best. You could look at where your stop should be. And then, implement it. Start practicing that. Use the simulator so that you're not, wasting money. And then once you have enough experience and enough time doing it, you'll be able to trade with real money. And if you're ever not sure what to do, just take a break. Take some time off and come back to it. And look to your intuition. To me, the next message you need is always right where you are. And I believe that you always know what you should do. You just have to listen. And just for the record, on this chart, which was Friday, 96% of the bars got a second leg. So it doesn't even matter if you trade micro channels or breakout follow through or reversals or stop entries or what it is. I mean, most of the bars on every single chart get a second leg, most of them. And if you think about it, the only time where some of the bars aren't going to get a second leg is when the market is in a trend or a strong breakout. So the signal bars don't really even matter. The context is what matters. So anyway, that's the video. Hope you enjoyed it. Like, subscribe. Let me know what you think. Let me know where you're at. Let me know if you would like to see anything else. And I will see you next time. Thank you. Bye.